All right, ladies and gentlemen, let's begin. Octavio, you've got your first question here. Mike, what is your opinion on using SPX short straddles? And what structure setup will you consider? Okay, so let's get a little bit personal here. Let's go into short straddles. So we're all on the same page. I'm sorry, let's add short straddle. I'm also going to add in short strangle. All right. What is a short straddle position? In general, a short straddle consists of selling a call and a put without owning any other options, an additional long call, an additional long put to act as a butterfly position or perhaps a condor. And by definition, a straddle, of course, we're selling at the same strike to get this tense profit and loss chart. Okay, this usually can only be done if you have level 4 trading in a margin account. They typically won't let you do naked calls, naked puts, naked calls, or the short straddle or short strangle, which take into account a naked put, unless you're on level 4 trading, which, depending on your broker, may have other requirements, $1 million perhaps, or some minimum amount of funds available in a free margin account. By definition, Octavio, this is usually done at the money. Why? Well, before you've heard me discuss the at the money bell curve, where the time value is richest right at the money where the current index or underlying is trading, and the time value decays as you go in the money or out of the money with respect to if you're looking at a call or a put. Okay, so it's typically done right at the money to maximize the time value and give you potentially the widest break even, upper and lower break even. If you decided to skew the strangle position, meaning that you're bearish, so you're going to sell a little bit below, strikes a little bit below the current underlying price, or you're bullish, you expect it to move up, so you're going to sell here. Well, that takes a lot of different timing, and that takes a lot of guts, for lack of a better term, in my opinion, to try to do that, because you're starting off with one option, the naked call or the naked put, being in the money. Regardless of the fact that SPX has a lower volatility than a standard stock, you might get a rich premium for doing this short straddle or short strangle position, say on Tesla or something along those lines. The idea of doing this along the lines of an ETF or broad market index is lower volatility, so you don't expect much movement one direction or the other. Another advantage, of course, of doing this type of position where you're in both a naked put and a naked call on an index is that you can't get assigned early. You just have to do cash settlements at expiration to cover the leg that's in the money in that case, to buy it back instead of risking assignment. Okay, that's what a short straddle is. A short strangle is the similar approach, but in the short strangle position, you're going to start by selling an out of the money naked put and an out of the money naked call. So now usually the index or the underlying is priced right in the middle of those two short options, so it can move up a little bit, move down a little bit, or stay the same before you start losing money. You take in less premium for these positions, which means that the upper and lower break even, you will have a upper and lower break even, are different, but you're still in a naked call and a naked put position combined. Very rich premium, very management intensive, and prone to extreme risks to the downside and to the upside of the position as well. That's the broad definition of a short straddle and a short strangle. Your question is, what are my thoughts on the short straddle or short strangle on SPX and how would you structure it? My thoughts are, I do not touch these strategies personally. Two reasons. And I'll get into this a little bit in just a moment. But two reasons. Number one, my IRA account, where most of my capital is, I can't do level 4 trading. In my cash account, I don't have the funds required at that broker $1 million in free capital, I believe it is, with my other broker there to qualify for level 4 trading. So I can't do them, okay? I would do these positions potentially as a butterfly, the iron butterfly, where I'd be buying 2 outside wings away from the short put and the short call there as well, so that I have a capped gain and it's just a credit spread. It's not a naked position, okay? So let's look at a structure of SPX. And again, we're going to look at 2 different examples here on the short straddle and short strangle. And I would not recommend this for anyone, not only if you're not on level 4 trading with your broker, and you'll see why in a moment, okay? I'm sorry, I'm not going to recommend this to anyone who's just getting into options trading, has just been trading covered calls or maybe even some credit spreads. These strategies are intense and usually amount in a large amount of losses more quickly than you see returns. SPX, I'm just going to try to go out a couple weeks here. You could do a 10-day, you could do a 0-day, I'm sorry, a 1-day trade if you wanted to. Let's go ahead and go out to December 24th. Let's just go out a week. Remember, options expire next Thursday at 12 noon because it's a shortened week, okay? All right, so what I would typically do, of course, is to maximize the time value, the highest time value following the at-the-money bell curve is you're going to sell an at-the-money call, naked, and an at-the-money put. I'm going to use 37.10. I could use 37.05, but I'm going to focus on 37.10. All right, we just added those in. We're going to sell one of each. And I'm just going to use one contract, folks, so we can keep the math simple. Now, as you saw from Octavio's initial question, we're getting a decent premium here. We're getting almost $50, $51 almost in premium. So for one contract, that's $5,195. I'm sorry, let me really get this going here. We got to pull this wide. Of course, okay, geez, that isn't giving me a great position as well. I might switch to SPY just as an example. I don't know how your broker handles it, Octavio. There are some rules on the requirements for short straddles and short strangles. You are selling a naked put and a naked call at 37.10. Full cash secured allotment is $740 some odd $1,000 to make $5,000. Okay, so 50 points. Your break even would be 36.60 to the downside and 37.60 to the upside. That's why I might switch my graph so that we're looking at SPY, not on SPX, just as a visual, but you get the general idea. Now, this isn't real. The tool is showing this because it's reading a naked call and a naked put. Brokers have different ways of doing it. A common way is the short put strike price, or the short call strike price, I believe, plus the monetary plus the premium received from the short put and potentially 1/2 of that total value. Or they might do the full short call strike plus the premium. So the margin requirement here would be $373,000. And if you take a half of that, of course, we're looking at about $187,000. Okay, so again, that depends on your broker and what they charge for the margin requirement. You can't do something for nothing. You have 100-point upper and lower break even, or 50 points down from where you are at the strike price at 37.10, which is, as I mentioned, right at the money there with SPX at 37.09. Is SPX going to stay at 37.09 or just at 37.10 or within maybe 1 or 2% of 37.10 within the next 6 days? Not likely, which means that this short straddle position where you have a peaked profit and loss chart is going to require some cash to put back, because there is no way 0.2% of 100 trades, maybe 0.3% of 100 trades, are you going to be trading right at the short call, short put strike price. Another 5% of the time you might be here, another 10% of the time you might be here, 15 to 20% of the time you might be here, all still small profits. But the allure of this max profit with this high premium is very rarely ever realized. It requires management. customer Power Options, a very smart investor I talk to on a regular basis. MV called me up today asking me about doing a in-the-money bull call debit spread or an out-of-the-money bull put credit spread that we'll get to Kevin with shortly. Just a couple strikes out of the money. I think he was looking at the 36.95, excuse me, doing like a bull put with the 39.65, 39.60, opening the trade this morning and closing it before trading ended. He wanted to know what success rate can he experience. I don't do that. I've never done that. And most of you know the reason why is that most of the day I am on the phone with the coaching sessions, or I'm looking a little bit at my own trades, of course. I'm writing the webinars. I'm posting webinars and doing other things. I don't have the time to spend to watch that position as much as I would want or need to, lack of a better term, because if SPX started to go against me, I've got to manage the position. I've got to be on my toes to roll or adjust the position. This is 6 days, 10 days out, Octavio. Why am I mentioning that? Because you're starting off right at the money, meaning that you're starting off with an option that at some point, either one of those very quickly is going to be in the money and you're going to need to manage or roll it. Almost like a lot of investors talk about the butterfly positions. I'm going to go to SPY real quick, see if we can get a better graph. And the 370, it was a 371, wasn't it? I'm sorry, 371s. Would be comparable to the 3710 that we talked about. Let's see here. Yeah, I'm sorry. I just want to get a better graph, and that one wasn't going as wide as I needed. Sell. Yeah, that's a little bit better. 36. Oh, it changed. So let me go back to the 370s. Not much, but let's go back to the 370s for this straddle and keeping December 24th. Okay, excellent. Okay, I'll do that quick, Octavio, but it's irrelevant. Doesn't matter which expiration you use. You're still focusing the same thing. Tony does add that for this straddle, for SPX, they'd want 92, I'm sorry. Oh yeah, 92,671 would be Tony's margin requirement for the 3710 straddle. Okay, so 92,671 to make 5,000. That's essentially a little bit more than a 5% yield on the return. Okay, did I do that? Sorry, folks. Thank you, Tony. I didn't know that as well. All right, so there you go. There's your tent profit and loss chart. As I mentioned, you know, the 365 down in this case, 375-ish. Let's just call it 365 and 375, essentially what I said. So you're 6 points up, excuse me, and about 4 points down to hit break even. And as close as I'm trying to get to 370, we're already starting off. We should probably use 369, but in any case, we're already starting off with one option slightly in the money. On SPX, remember, that's not an issue. You can't be assigned early in that case. Okay, so here instead of this amount here, 1/10 of that be $9,267 at the 1/10 here to make 500. With this SPX, it'd be about $5,000 to risk, as Tony gave to us, 92,671. All right, you could go out further for more premium, increase the upper and lower break even, and be in the profit levels here, but one of those positions is going to have to be adjusted. Okay, and you don't want it to get too far away from you. You're probably managing it more constantly. Another approach in general that investors are using, I'm going to stay here on SPY, is instead of doing those right at the money with the tent profit and loss chart, similar to an iron butterfly or an all call or all put butterfly, which would require consistent management. That's why I don't trade those positions. And again, that graph I showed you, everyone's, well, let's do a strangle first here. We'll go a little bit out of the money to your break even. I'll go 365 and 375. Okay, so what does that mean? Now I'm not going to be collecting $500 or $5,000 in premium one contract. We're going to be collecting much less. But before we risk one of those options going in the money, the stock has to fall further. So now I've got a much lower break even and a much higher upper break even, a couple points, and I'm making about a third with the strangle position. But now that's the underlying can stay the same, move up or move down in price. Okay, so that's the difference really between the strangles and the straddles doing short positions. I just don't do them personally. They're not my cup of tea. If I added outside wings to this short strangle 6 days away, let's do 5 points. I do a 360 put. I buy it. I do a 380 call. I buy it. I'm essentially doing a bull put credit spread with a bear call credit spread. This to me is going to create an iron condor where now I only have to put up the difference in strike prices on one side of the spread or the other. I've got still the wide room for the index or underlying to move up or down before I'm getting threatened on that position, before I have to worry about adjusting the short call or short put. But because I bought the extra wings on the outside, I'm still making a decent premium against the risk, close to a 27 or 30% return. But again, these are pretty tight windows to get a reasonable premium. And you'd have to manage those exactly like that. On the straddle, the short straddle with the same strike price, if I added the outside wings to the positions, it would create a butterfly. Is that necessarily a bad thing? No. But again, you guys have heard me say before, I personally don't trade the butterfly positions. Yes, I understand. Oh, I'm sorry. I wanted to do the 369s here. And I'm going to leave my outer wings up there. But we're going to sell the right at the money 369s. Because the price has changed from when we started it to the last data came through. Why is one a 5 and one a 10? Because I wasn't thinking straight. Okay, I should go 360. Yeah, I should do it that way. I'm sorry, folks. Let me get an even butterfly. And I know this isn't what we were asked. So let's go 5 points down. Let's go 364 and 374. That'll look much, much cleaner for our position. Now, again, I'm still selling the at the money, short call and short put. We're adding the outside wings. This creates a butterfly. Similar process to the short straddle that you mentioned, at the money to maximize the time premium. But we added the outside wings to have a lower maximum risk on the position. This is why I'm saying that these positions look really attractive, and the short options to maximize return, as Octavio mentioned, by just selling the naked call and the naked put, if you're qualified to do that, looks very attractive. This looks attractive because I'm reverse on my risk reward with this butterfly. Instead of risking 4 to 1 with, say, a bull put credit spread that's out of the money, or bear call credit spread, or 5 to 1, I've got a 1 to 3, not quite, but close to a 2.5 to 1 risk reward ratio. I can make almost twice as much, 2.5 times, okay, 2.3 times as much on the position than I'm risking. Historically, though, what do you see with this position? It's going to be management intensive. Why? 0.2% of the time you get that. 0.2%. Is it trading right at the strike prices where you started after 6 days, or after 30 days? You're talking about, Octavio, going to January 15th. 5% of the time you're in this range. Maybe 10 to 15% of the time you're here. Okay? And maybe about 20% of the time you're here at a profit, and another 20% of the time, well, maybe another 10 to 15, you're about here. Okay, so 30, 50, 55, 55.2 at the max. And maybe this is more like 20%. And then another 10 or 15% of the time you're here, and then 5% of the time you're just way out here. So that max profit you're expecting and that great risk reward, you don't really see on a regular basis. You're here most of the time. Still a little profit, but probably a profit of 45 or 50, still 3 to 1 to the risk on how the strategy plays out over time. Okay, I know that's a little bit hard to read, but that's what we typically see with these structures. And it's the same with the short straddle, although the short straddle might have a lower break even and a higher upper break even because I didn't buy the outside wings. But when those losses start to come, they start to come quickly. In any black swan event, you're getting destroyed. Okay, that's why I don't trade the short straddle, the short strangle. I don't trade the butterfly positions, either iron or all call or all put, even though this risk reward profile looks very, very tempting and looks very promising. But again, that's just numbers. The graph and seeing it play out in real time and in the market, you rarely are in these ranges. You're maybe here, it's still a decent profit. You're still about a 1-to-1 risk reward ratio, 20-25% of the time. And then down here, 10 to 15% of the time, we're still at a 3-to-1 risk reward ratio. Okay. All right. Yeah. Sam just asked, why trade butterfly? I don't understand the butterfly. I'm not saying to trade the butterfly. I'm saying that I don't trade the short straddles, as Octavio asked, or the short strangles. I would maybe do an iron condor as opposed to the short strangle. Remember, going out of the money with the sold call, out of the money with the sold put, and so forth. And, with the iron condor position, with the outside wing, so the margin requirement is lower. This is something I'd consider. But to be honest with you all, as I always am, I've not traded an iron condor since about 2016, or used an iron condor as a management against a bull put credit spread since about 2016. Why? Well, when you look at the market conditions, 2016 and 2017 were almost lower left to upper right. The bear call sides were getting killed during this time. It was taking away from profits. If you just did the bull puts, you were seeing close to a 90% success rate. 2018, February 5th, a little bit of a gain, March 20th through April 5th, a little bit up through August, a little hiccup August 5th, then October, then November, then December. So would be managing the bear calls here, loss on some bull puts here. Maybe manage the bear calls here, have good, manage the bull puts here. Manage the bear calls here, little bit of hurt on the bull puts, but it wasn't that bad. Getting hurt on the bull put side, recovery in November is a little bit more, getting hurt on the bear call side, and then it declined. Okay. So an iron condor, short straddle, or short strangle, we're getting whipsawed, or a butterfly, we're getting whipsawed during that year. 2019, a little bit better. Let's not talk about 2020. We're going to save that for a recap coming up in the next week or so. Okay. So I'm going to be dead honest with you, because I always am. If you want to pursue short straddles with no protection, maybe even short strangles with no protection, and you want the best insights possible for those strategies, Octavio, I'm going to be honest, I'm not your man. I can tell you everything I know in theory, what I've seen in practice and historical testing from other PowerOptions subscribers. With relation to how infrequently you're here, how only maybe 5% of the time you're here, about 10 to 15% of the time, or 10 to 15 you're here, 20% of the time you're in this sort of wide swath, and another 10 or 15 you're a little bit of gain, a little bit of loss, assuming no management, and then maybe another 10% you're down here, and then 5% and 5% at the max loss. With the short straddle, it's very similar. You just don't have these extra legs for protection to stop loss in that 5% of the time when it really just goes against you one direction or the other. It's management intensive. The profits aren't expected to be here. I'll do this a little bit more correctly. The profits are never expected to be there. Anyone who enters a short straddle, iron butterfly or standard butterfly, knows that they're going to be managing it at one point or another, because something is going to have to be bought. If you're doing it on standard stocks or ETFs, at some point your short call, your short puts in the money, and you're risking early assignment. Thankfully, Octavio, I would say the approach with the indexes is better, because you just have to worry about cash settlement at the end. And that's why I feel it's not a strategy for me personally. And I don't have direct trading and real world experience with this, just a lot of theory and some tests that we've done, back testing tests that we've done for PowerOptions customers over the year. I'm not just grabbing that 0.2%. That's literally what we saw, 0.2, 0.3%. Or I saw when I ran this for a customer a couple years ago, of how often the max return was achieved over about 50 trades. Okay, so management intensive. Going further out in time, of course, to January would give you a higher premium and a better upper break even and lower break even, but it's still the same structure. You still have the same expectations. Yes, I saw William's comment and I put the star on top. So 'tis the season. Our short straddle and butterfly markup here looks like a little Christmas tree. Absolutely. Tony says, so great. A general rule is never to do a trade where your risk is unlimited. That is my personal approach. I don't consider cash secured naked puts as a truly unlimited risk, Tony, because you do have a floor if it goes to zero, but you're usually trading a naked put on a quality stock you'd want to own. The naked call does offer infinite upside. Short strangle and short straddle, as much premium as you receive, you still have the infinite risk to the upside and to the downside in wild swing markets. William says, seems like a lotto ticket strategy. Yeah, it's kind of not for me in that case. It's just something that it's not a strategy that I prefer to do. So Octavio, those are my thoughts on it. That's the structure of it. That's my sentiment on what you would be looking at with doing this strategy in your portfolio management technique wise. Although that top max premium looks attractive, it's very rarely, in fact, almost never realized that simply. And without management, those I know who trade these strategies, PowerOptions subscribers and others who trade the butterflies and who trade the short straddle positions, they know they're managing it. It has to be managed consistently as well. All right, so okay, Fernando did. All right, so okay, let me see here. Let me go back down. Okay, all right. Octavio, great. That's just my thoughts on it. And so going back to that statement I made, my apologies, one quick thing. I mentioned that I'm not the person if you want real in-depth analysis of management and real-world trading experience. I'm going to be honest, you might have to find another options educator that promotes that strategy and teaches that strategy. Because if you're going to pursue that, I'll do my best to help you, but I just don't know if I'm the right person if you're going to be employing this into your personal trading account. Okay. All right. So let's go back up here and let me see here first. Sam, we'll just cover Sam's comments here. Of course, he says, hi to everyone in the room. Hi, Sam. It's great to see you here. You had a fantastic trade on Lumpkin Coffee. I did see that move recently. 3 months cost was $250, 1,000 shares, and today a handsome profit at $10. Excellent. That Lumpkin Coffee really did take off. That Penn position, Penn Gaming, has been working really well. Bought at 6, sold at 30. Next trade in at 50, and today at 91. Wow, Penn's already up to 91. Unbelievable. That's a Mary put I had a while back. I had a coaching session with Maurice today. He was looking at a really good position that he was in, I believe it was APPS. I think his cost basis from a couple months ago was to 22 or 26, and it breached, of course, 58 today at one point. Going back to the straddle and strangle, you've heard Sam talk before on this, and he does straddles and strangles, Octavio, but he does the opposite. He'll be doing long straddles and long strangles as a base point that are maybe 3 months out at time. Right now he says, I'm going to spy straddle, but it's long. He's at the 370. He's long the call and long the put. And he's selling SPY calls. He sold today SPY calls at 375 that expired worthless. So he's using this to manage swings up and down. He might roll the put or roll the call as well. And in that case, he's doing the long straddle and the long strangle, mimicking sort of stock ownership, but also having profit to the downside as they move down. And then when he thinks he's at a top, selling premium against it. I'm sorry, this is the 375. Selling premium against it to hedge the cost over time. All right. Fernando adds that short strangle is high management, high commission, and a relatively high margin, as Tony mentioned to us before. With the full risk in mind, Fernando feels that just as Tony and William had kind of mentioned there, and that I mentioned, that risk of that unlimited risk, the risk of the true unlimited risk, and the stomach pains and butterflies you might get through with that trade sometimes don't always work out to maximize, work out to really counter the profits that you do receive. Oh, there you go, Sam. You did mention that too. You and Maurice. You said top stocks you have are Roku, Baidu, PayPal, Apple, Facebook, and apps. LOB traded all and out with a profit as well. Okay. All right. And Sam's using that long, of course, to look for big swings one direction or the other. If they don't happen, he's able to sell premium in that case as well against it.